Bitcoin currently is around 1/10 of the size of gold. So you're talking about like a $2 trillion network compared to like an estimated $20 trillion monetary network. And that's in a sea of, like $1,000 trillion worth of global assets. So, when major banks kind of look around and they try to estimate how much real estate's out there and global equities and global currencies and global bonds and gold and art and Bitcoin and everything else, these are both kind of tiny percentages. And I think they're both growing into that much larger sea of assets. I think Bitcoin is moving faster because it's starting from that smaller base and it's younger.
Lynn Alden has a simple way of framing it. Gold and Bitcoin aren't rivals, they're tools with different jobs. She's been bullish on both for years, but she treats them as complements rather than substitutes. Bitcoin, she says, is best understood as a protocol, like the ones that make the internet or email work. It's the new digital layer for transmitting value globally. Yes, it relies on technology, but as long as people hold their keys, ownership is secure, even if the lights go out for a while. Gold, by contrast, is the ancient anchor. Its monetary network is worth around $20 trillion, while Bitcoin sits near $2 trillion. That sounds large until you compare it with the hundreds of trillions tied up in equities, bonds, and real estate. Both gold and Bitcoin are still tiny against that backdrop, which is why Alden argues there's plenty of upside ahead. Bitcoin, thanks to its network effects, is simply growing faster. From a portfolio perspective, Alden points to fiscal dominance. The reality that debt levels are so high governments will prioritize servicing them through inflation. That makes bonds increasingly unattractive. Her solution is to swap some bond exposure for gold and even replace a slice of equities with Bitcoin. The overall risk profile remains similar, but the potential upside in an inflationary world improves dramatically. For Alden, it's not an either-or choice. Gold provides stability, Bitcoin provides torque. Together, they offer a hedge against currency debasement and a shot at capturing the upside of a changing financial order. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
So I'm bullish and long both, and I have been for many years now. Gold obviously has the long-term history and the irreplaceability as a hard physical money. Bitcoin is 16 years old, so it's newer than gold, but it has portability enhancements compared to gold, and it also has absolute scarcity. So over time, it right now, for example, its supply growth rate is lower than gold. It also has certain kind of benefits of speed. So for example, if we both had a Bitcoin wallet, we could hold up our phones and I could scan your QR code and we could make a payment right over this call. Whereas if we were to do something with gold, it would require a chain of credit and counterparties in this type of environment. So they have different pros and cons. And then especially when we consider that there's a global world. So in the United States, many of us don't think about crossing borders too frequently. But in many parts of the world, people are in Lebanon, people are in name the country that's having some sort of currency crisis or political crisis, and people might save their assets and want to leave with them, which is not always possible with other types of bearer assets or securities and things like that. So a self-custodial portable ledger is very attractive. I kind of view it like a new protocol. So there's Ethernet, there's simple mail transfer protocol, there's internet protocol, there's USB. There's all these kind of communication standards that we've kind of solidified around for many decades. And I view generally Bitcoin as achieving network effect dominance as a communication of value. So obviously it relies on our technological connectivity to varying degrees. It's robust to handle shocks. If your power goes out, you still have your keys, for example. You just can't transact in the moment. So it is quite robust, but it's a different system than gold. So I think that they serve different purposes. Bitcoin currently is around 1/10 of the size of gold. So you're talking about like a $2 trillion network compared to like an estimated $20 trillion monetary network. And that's in a sea of, like $1,000 trillion worth of global assets. So, when major banks kind of look around and they try to estimate how much real estate's out there and global equities and global currencies and global bonds and gold and art and Bitcoin and everything else, these are both kind of tiny percentages. And I think they're both growing into that much larger sea of assets. I think Bitcoin's moving faster because it's starting from that smaller base and it's younger. But they often go up and down at different times, and I've generally been long both. And one of my kind of recommendations, or the way that I've been doing it at least, is to say if you start with a 60-40 portfolio, that has some frictions in a fiscal dominance environment, especially the 40% bond portion. So my general view is, to tailor it toward a more debasement environment. If you swap out at least a portion of those bonds with gold, that's beneficial. You get kind of a similar volatility profile, but generally better returns. And you can also consider swapping out a portion of the equities with Bitcoin, where you have similar high volatility asset. It's been an attractive mix so far. So I'm bullish both.
For decades, central banks controlled the rhythm of the economy. By nudging rates up or down, they could influence credit creation, slow things when inflation ran hot, or juice growth when it cooled. That lever shaped the entire business cycle. But Alden points out that once debt loads, especially government debt, grow too large, the dynamics shift. We've now crossed into what she calls fiscal dominance. In this environment, government deficits aren't just big. They're bigger than all the new credit created by banks or corporate bond markets combined. Fiscal policy takes the wheel and monetary policy becomes far less effective. Here's how it plays out. When debt to GDP is modest, raising rates discourages lending, which dampens inflation. But today debt sits at around 120% of GDP. Raising rates in this setup doesn't just cool lending, it makes the government's interest bill balloon. That widening deficit pushes even more money into the economy, which ironically keeps inflationary pressures alive. In other words, the same tool that once slowed inflation now risks fueling it. Alden says this is why the traditional playbook doesn't work anymore. Central banks may still look powerful, but the true driver of economic outcomes is fiscal policy, because deficits dominate the flow of capital. The old cause and effect of rate hikes has broken down, replaced by a system where too much debt changes how the entire machine responds. Let's get back to the interview.
So basically, it's a new regime change, right? And so it's a different investing environment than most people are used to over a, call it a 40-year investing time horizon, basically anybody alive and trading today. And so for the past 40 years or so, kind of before 2020, we can call that period monetary dominance. And that's an environment where, for example, bank lending, and by extension, the central bank that, has various tools to accelerate or pull back on commercial bank lending, that's the more dominant thing that causes kind of business cycles and contributes to what's going on. And what happens over time as debt builds up, especially on the public side of the ledger, so the federal ledger, we gradually shift over more toward fiscal dominance, which is to say that fiscal deficits are now larger than the amount of new bank lending in a given year, and even the amount of bank lending plus net new corporate bond issuance. And so fiscal dominance is a more driving aspect of the economy. And then also there's the added issue that, when central banks try to slow down inflation or slow down the economy in general, when they raise interest rates, they do that to try to slow down bank lending. And the problem is that, when you have, say, 30% federal debt to GDP, that works pretty well because when you raise interest rates, you slow down bank lending. And while you do contribute to the federal deficit because you contribute to the federal government's interest expense, the slowdown on bank lending is larger. But when you fast forward to the present day and you have something like 120% debt to GDP and you raise rates, while you do slow down bank lending, you actually blow out the fiscal deficit even bigger, even by a larger absolute dollar amount. And that's actually somewhat stimulating for parts of the economy that are receiving it, and somewhat inflationary as a cost of that. And so basically their tools work differently when you have fiscal dominance. And it's not just like a one-year thing or a multi-year thing. It's kind of a new regime that we find ourselves in more structurally compared to that past 4 decades. Yeah, during fiscal dominance, I would certainly not want to be the head of a central bank because basically all answers are bad. And it's mainly because the issue is just outside of their purview and it's outside of what their tools are designed to do. So their tools of interest rates are primarily meant to either accelerate or decelerate bank lending and therefore, fractures or money creation, or they're meant to basically harden the exchange rate compared to other currencies and make it, disinclined speculators from, say, borrowing the currency to buy another currency or something like that. And so they have that tool to try to slow down inflation, and it can work under certain environments. But the costs of doing that are different under different environments. So we have this notion that higher rates can tamper down inflation, and we primarily get that from the 70s. But that was, again, a very bank lending driven type of inflation. That wasn't primarily because of fiscal dominance. Whereas in the current environment, bank lending rates are normal, and they were normal throughout the whole kind of pandemic lockdown and post and the inflation period we went through. None of that was because of excessive bank lending. Instead, it was because of very large monetized fiscal deficits. They were explosive, obviously, from the 2020 and 2021 period. Now they're less they're less gargantuan, but they're still sustained at that 6 to 7% GDP level. And so as they try to raise rates, they do get the effects of less borrowing and a harder currency compared to other currencies. But then they blow out the fiscal deficit. And so really, it's kind of like treating some of the symptoms and even exacerbating, ironically, some of the other symptoms rather than really going after the root cause, because the central bank doesn't have jurisdiction over taxing and spending. And so the best they can do is mention it. And it puts them in a really difficult place just because their tools either they have mixed results rather than clear outcomes. It's almost like a patient with multiple conflicting ailments, and a medicine that might fix one ailment makes another ailment worse. So there's kind of no good answer at that point. And that's really what the Fed kind of finds itself in. In general, I would somewhat separate the concept of debasement from inflation, because inflation also has a productivity component in it. So as you increase the money supply, what happens with actual prices of goods and services will partially depend on what's happening with productivity growth. You can imagine a scenario where money supply is growing pretty quickly, but productivity is also growing pretty quickly, and so prices are not. So, for example, televisions over the past 20 years, they don't grow in price because despite all the debasement, the productivity of making TVs has been so rapid that it's kind of offset those price increases. Whereas we don't get radically better at making gold. We don't get radically better at making other pretty scarce things, waterfront property, fine art, and anything that's kind of energy intensive and very labor intensive. Those things have generally gone up in price, pretty close to the longer term debasement rate, because they don't really have much of a productivity offset. And so during fiscal dominance, it depends on what's going on with those productivity offsets, and that can influence CPI readings and so can other things like tariffs or the ways they even measure it. But when you do look at the generally the most scarce things, especially if they're not in a local bubble, like with very high levels of euphoria, you should generally expect that you'll get pretty good sustained performance from those scarcer things. That doesn't mean that you can necessarily buy things at any price. I mean, sometimes things go up really quickly and they're prone to cool off for half a year or in some cases even multiple years. So you still have to watch out for valuations and sentiment to some degree. But generally speaking, I'm bullish across the board on scarcer assets than what you generally find with currency.
What stands out in this new era is how the traditional levers of stability no longer deliver the results they once did. The feedback loop between towering deficits and persistent inflation is reshaping the investment landscape, forcing individuals and institutions alike to rethink what real protection looks like. Assets once considered the bedrock of safety, like government bonds, now carry risks that were previously unthinkable. In their place, tangible stores of value and decentralized networks are stepping forward, not as speculative sidelines but as central pieces of a defensive strategy. When the old rulebook no longer applies, the search for alternatives isn't optional, it's inevitable. The real question is whether investors will adapt quickly enough to this structural shift, or whether they'll cling to outdated assumptions until the cost of delay becomes impossible to ignore. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.